When I say that the stock looks insanely cheap, I'm not talking about it being $5 a share or less. I'm talking about a healthy, growing company trading for far below its fair value. Meaning shares trading for $1,000 or more could still very much be a value stock if it's worth $1,500 or more. So here's the problem. Most seemingly value stocks are discounted for a reason. That's because their business is declining, with future earnings prospects only going from bad to worse. But every so often, the market misprices a generally good business, and that's where the real value opportunity lies. Today, I'm breaking down 5 severely undervalued stocks that deserve a spot on your watch list. Everyone earns an elite A rating from our proprietary quant ratings model and has real catalysts working in its favor right now. If you like this theme, then I strongly suggest that you tap that like button right now. It tells YouTube to put more no-nonsense stock research like this in your feed. We will start with Expedia with a symbol of EXPE, a name you likely know is an online leader of the travel industry. But before I jump in, I probably should tell you who the heck I am. I'm Steve Reitmeister, but all my friends call me Righty. I've been investing for over 40 years and currently a partner at Wall Street Zen, where our quant rating system analyzes a wide array of data points to separate the best opportunities from the rest. And remember, this is not personalized investment advice. Always do your own due diligence. Now, okay, let's get back to Expedia. Now, back in March, it got knocked around as the Iran conflict sparked a serious rise in energy costs, which is always a negative for the travel industry. Now, the market fully expects a peace deal with Iran to come together sometime this year, and as such, energy prices are lower, and those travel fears are starting to melt away. Gladly, Expedia is still well off the highs, making it a clear value play at this time. Expedia was one of the most consistent companies each earnings season, with a long streak of earnings beats on hand. Even better is the expected 30% earnings growth in the year ahead, which greatly outpaces the average company. Back to the value story. One of my favorite quick gauges of value is the PEG ratio, which measures the price you pay against how fast the company is growing. Given that the average stock trades for a PEG ratio of 1.5, then anything under points to value. In this case, Expedia sits at 0.72, which just screams to a severely undervalued shares. Now, here's where our data comes in. Expedia earns an overall Zen rating of A, which equals a strong buy recommendation. In this case, we are talking about a stock in the top 2% of the more than 4,600 stocks we track. Our quant system evaluates 115 different fundamental factors. The top 5% earn an elite A rating. The next 15% still come in an attractive B level. Both point to great odds of future outperformance. This is why we want more A and B rated shares in our portfolios. Under that headline rating sits 7 component grades that let you see where a stock shines and where it doesn't. Expedia's artificial intelligence grade comes in the top 23% of all stocks tracked. This grade reflects our proprietary AI factor that leverages machine learning to locate stocks that are likely to be timely picks in the weeks and months ahead. Things get even better from there when we look at the component grades like sentiment landing in the top 15% of all stocks. Growth is right behind that in the top 15%. Then we jump up with value to the top 4% of all stocks, and financial strength caps off this story with a top 2% showing. The read on all this is straightforward. We have a rock-solid, fast-growing travel leader. The market oversold on energy concerns that are starting to blow away. This leaves behind a growing value play in its wake. I should also point out that I recently added Expedia to my Zen Investor newsletter portfolio. That's where I feature my top 20 stocks for the long haul. The goal is to hit more home runs with less strikeouts. Before I keep going, if you like timely stock picks like this, then the best thing you can do right now is sign up for my next live training session this coming Monday. The focus is on timely market insights plus top picks. It's totally free, but you do need to sign up. Do that now to join me this coming Monday at 7 p.m. Eastern Time. Just go to wallstreetzen.com/live. Now, the next stock the market has all but left for dead. We are talking about OpenText with the symbol of OTEX. They are an enterprise software company that helps giant organizations manage, secure, and make sense of mountains of data. And there is a fresh chapter starting here. A new CEO stepped in this year and is repositioning the whole company around enterprise AI, including a push to run its data platform on Amazon's new sovereign cloud in Europe. Now, it's not like this is a turnaround story because the company has put together an impressive string of 7 straight earnings beats. While you wait for the market to notice the AI pivot, OpenText pays you handsomely. That's because it throws off a dividend yielding about 4.7%. That dividend will likely increase in the future, as they have done that for 10 years in a row. All this growth plus healthy dividend, and yet investors have basically left it for dead with a rock bottom PEG ratio of 0.52. Shares would literally have to triple to match the PEG of the average stock. Let's put OpenText under the microscope of the Zen ratings model. In this case, we have another A-rated strong buy stock. In this case, they score in the top 4% of all stocks we track. The component grades echo this bullish story. Sentiment comes in at the top 22% of all stocks tracked. This means the smart money is moving into shares. Growth is even better in the top 13%. Safety, top 10%. And the artificial intelligence time in this grade jumps to the top 2%. And value, of course, this is the whole purpose of this video, is in the top 1% of all 4,600 stocks analyzed by our system. The only real soft spot is momentum, down near the bottom of the list. And honestly, that is a big part of the value story here. This is a hidden gem value stock perfect for patient investors who can wait for things to pay off. Odds of that are pretty darn good given their growth and earnings track record. And while you wait for shares to rise, you get to cash that 4.7% dividend check. The next name is the smallest and most under the radar stock on this list today. Now we're talking about Regional Management with the symbol RM. This is a consumer finance company that makes installment loans to everyday borrowers who don't always have access to the big bank. This is boring on the surface, yet the numbers underneath are anything but boring. Here's the operating leverage that caught my eye. Over the past year, revenue grew right around 10% a year. That's pretty solid, but that actually translated into a mind-blowing 50% earnings growth. When a company turns modest top-line growth into earnings growth 5 times fast, that is an earnings momentum story at play that typically ends up with a much higher share price. And yet, once again, the PEG ratio points out the deep value story here as it trades for only 0.55. Just like OpenText, you will also get a hearty dividend on top. In this case, we're talking about 3% dividend yield. They have grown for 6 years running. The best part is the payout ratio is under a quarter of earnings, so there is plenty of room for that dividend to grow even more in the future. Our system likes the whole picture as Regional Management earns an overall Zen rating of A. This is based on its remarkable fundamental profile, which comes shining through with the component grades, starting with top 13% for sentiment. Safety is a notch higher in the top 10%. Then it's artificial intelligence timeliness grade and financial strength. Both land in the top 8% of all stocks, and value rounds out the story in the top 5%. The catch is the nature of this business. We're talking about consumer lending, so a weaker economy or rising loan defaults would put pressure on the shares and is worth keeping an eye on that. But honestly, not much risk on that front in the foreseeable future. All in all, we are talking about an impressive under-the-radar growth stock that also pays a healthy dividend and looks insanely cheap at this time. This is the kind of widely appealing stock that may not stay under the radar for too much longer. Quick ask before we move on to the last 2 stocks. If you're getting value out of this video, then hit that subscribe button. I publish data-driven stock analysis like this every week, and I would hate for you to miss the next one. All right, the next 2 stocks is where the quality really steps up. Indeed, we are going to end this video with a bang. Here we have Jazz Pharmaceuticals with the symbol JAZZ. This is a specialty drug maker with an established franchise in sleep disorders and a fast-growing arm in cancer treatment. Now, that oncology push is the main catalyst because the newer cancer therapy is expanding into more uses, and that is the real growth engine analysts think will drive shares meaningfully higher in the future. The oncology push is the main catalyst because its newer cancer therapy is expanding into more uses, and that is the growth engine analysts think will drive shares meaningfully higher in the future. The financials underneath only add to the overall appeal. Revenue is growing steadily, and after a bumpy year on the bottom line, earnings are accelerating again as the new drug scales. Now, add the new drugs they have in the pipeline, and you have a company whose best growth may still be ahead. Now, the disconnect. Despite that growth, the stock trades at a fraction of what a DCF model says it's worth. Now, DCF means discounted cash flow, right? A very standard way of estimating the fair price of any stock. And under that measure, Jazz is extremely undervalued. You can't put too much stock into any one metric, but when you turn to the Wall Street analysts, they back up the undervalued thesis. Not just a slew of buy and strong buy recommendations, but also fair value targets pointing to much higher prices in the year ahead. Indeed, our data loves the sound of Jazz too. Not just another A-rated stock, but in this case, it scores in the top 1% of all stocks based upon that full 115-factor review of the Zen ratings. In fact, Jazz is the highest Zen-rated stock in this video today. The component grades are truly an honor roll territory. We're talking about safety coming in the top 22% of all stocks tracked. We got top 16% for sentiment. Momentum slides up a notch to top 14%. Financial strength top 9%. Value top 4%. And saving the best for last year, growth is in the top 1%. This is the best category to foreshadow more earnings beats in the quarters ahead. The honest risk with Jazz is the same as any drug company. That being any clinical setback or new competition can certainly take a bite out of shares. But their shift into cancer drug drugs is paying off. This shows up in the strong Wall Street support, not to mention the top 1% showing in the Zen Ratings model. This is a quality value setup that might be the right prescription for your portfolio. Before we get to that last stock, one quick thing. If you want to stay one step ahead of the market, then join me live every Monday at 7 p.m. Eastern Time. That is when I share my updated market outlook and trading plan to outperform. This is also when I unveil my trade of the week based upon our proven Zen Ratings quant model and my greater than 40 years of investing experience. It's a free event, but you do need to register. Just go to wallstreetzen.com/live or click the link in the description or scan the QR code on your screen. Just pause the video for a moment to sign up. I can be patient and wait for you. Then I look forward to seeing you on Monday. It won't come as a surprise when I say our latest stock is another elite A-rated name, but this one might be the most overlooked of them all. Picture a profitable, growing company that our system rates in the top 1% of all 4,600 plus stocks we track, and yet amazingly only trades for half of its fair value. That company is Nature Sunshine Products with a symbol of NATR. They sell nutritional and wellness products in more than 40 countries. Now, the story most investors have missed is their digital transformation. Now, the old school direct seller approach has pushed hard into modern online and social media commerce and showing up impressively in the results. The company has been downright crushing Wall Street analysts for several quarters running. That's not easy to do because each beat comes with higher estimates and they beat that too. And the growth is flowing straight to the bottom line. In fact, they have turned mid-single-digit sales growth into earnings that have more than doubled in the past year. That is serious earnings momentum that for a while had shares on the upswing. But in the most recent earnings conference call, they noted that investment in future growth would increase this year. Too many investors took that as a sign to take their profits off the table, leading to shares selling off pretty strongly in the recent highs. Now, this may be one of the juiciest buy the dip opportunities around. Note that only 2 Wall Street analysts cover this stock. Both recommend it as a strong buy, but what is even more impressive is that the average fair value price targets, they point to roughly 60% upside in the year ahead. And our data backs up this whole bullish thesis. Nature Sunshine earns an overall Zen rating of A strong buy recommendation, and it currently ranks in the top 1% of all stocks in our database due to its first-rate fundamental profile. The strong component grades cluster right near the ceiling as well. Now, we have financial strength, the top 16% of all stocks tracked. Sentiment moves up to top 4%. The smart money is certainly leaning in. Value, top 3%. Artificial intelligence grade, also in the top 3%. And momentum is the one soft spot, still asleep. Fundamentals run ahead. So the pattern is deep value plus institutional grade sentiment on a stock nobody's watching right now, which is about as clean an early discovery setup as you will find. Now, one thing to respect here is size. This is a small company with a market cap of just around 360 million, so shares can be a little bit more volatile than the average. But if you're hunting a generally undiscovered bargain, then this is about as good of a contender as you will find. Honest, that 60% upside expected from Wall Street is probably on the low side if they keep up their monster earnings beat tradition. So this is what we're talking about today. The smart way to find value: 5 stocks with serious growth potential and somehow woefully undervalued based upon their impressive Zen Ratings profiles. And remember, the Zen Ratings are updated every single day. You can pull a free rating on over 4,600 stocks yourself just by typing in the ticker at wallstreetzen.com. So be sure to bookmark the site for the future. Now I want to hear from you. Which of these 5 stocks are your favorite? And is there a deep value stock you think I missed? Drop it all in the comment section below and let our community know. And if you want even more value picks, then check out my recent video featuring 4 deep value stocks to buy now.